Hello and welcome back to the Note, which unfortunately I'm having to record early today, so I'm unable to bring you a reaction to Apple's results, which come out after the market. There is still, however, a lot to discuss. Over in China, the Shanghai Composite has had another great day, up about 3%, with the result that it's now up 125% over the last 12 months. I'd like to continue to suggest that that sounds rather bubbly. In Europe, stocks have had a great day, and Greek bond yields are down very dramatically. That appears to be largely because Yanis Varoufakis, the Greek finance minister, appears to have been sidelined in the negotiations. They're having the very crucial negotiations they're having over Greek debt, and the market is working on the hope or assumption that his personal issues, his personality has been critical to the problems they've been having in those talks. We will see. Here in the US, the stock market has been decidedly mixed. That's largely because a few big mergers have run into difficulties. For now, I'd like quickly to discuss valuation and whether US stocks are overpriced. I think they are, and whether that means that we are likely to get an imminent correction, and we can't make that connection, I don't think. Now, what I'm showing you here is a chart that I wrote about in the long view at the weekend. It's produced by Barclays, and what it shows you is for every level of forward 1 year price earnings multiple going back to 1988, what the subsequent return over the following 12 months was. And you can see quite intriguingly that when the market has been at forward PE of 17, as it is now, it has never over that period had a fall over the last 12 months. I would not, however, put very much on that. I don't think it shows that the market is cheap, because if you look more broadly, you will see that there are plenty of examples of the market falling over the next year after being much cheaper than it is now, and obviously many examples of it falling after it's been more expensive than this. Broadly, what this research shows us is that 1 year valuations really tell us nothing at all about what's going to happen over the next 12 months. We can now show you what the average returns have been after each PE over that period, and again that tends to reinforce the message. Yes, you can see a downward slope to this line. Generally, the cheaper the stocks when you start, the more likely you are to get a good return, but that line is very discontinuous and oddly turns up at the end. You can't put any great weight on it. Does that mean that valuation doesn't matter at all, or that it doesn't matter for the long term? Certainly not. It's vitally important for longer term investing. Exhibit A for that comes from this research, which was done by AQR. This uses the Shiller PE, where you compare prices to the average earnings over the previous 10 years. And what AQR did here was split that into deciles. So you see, first of all, the cheapest examples of Shiller PE over history, moving up to the most expensive. And as you can see, when you then look at what subsequent 10-year returns were, the relationship is remarkably strong. You can generalize and say in the longer term, the cheaper you buy your stock, the stronger your return will be over the following 10 years. The more expensive it is, the worse your return will be over the following 10 years. As at the moment, the Shiller PE is at 27, one of its very highest in history. It's only been significantly higher than this twice during the Nasdaq bubble of 2000 and during the rally that preceded the great crash of 1929. I would like to suggest that over the next 10 years it still doesn't look a particularly exciting opportunity to invest in US stocks. Over the next 1 year, who knows?